So this is a journal entry for the purchase and consumption of supplies. On January 15th, the company purchased $700 of store supplies, plastic bags, wrapping papers, etc., with cash. So everything's paid with cash. Store supplies were counted on January 1st and January 31st. Values were 300 and 150 respectively. Use this to determine what supplies were used up in the period as supplies expense. Ooh, so this gets a little trickier because it's not giving you the amounts you need to do. You kind of have to do a little bit of algebra to get there. And don't worry, it's not too hard. Let's start with the easy stuff. Let's do the purchase. So let's do the purchase here. Purchase. The purchase of inventory of the store supply inventory that you have. So we're going to call it store supplies, and we're going to make it a debit. We're increasing it. This is something we can touch. We can touch papers, bags, wrapping stuff. So it's a debit of supplies, right? And that debit of supplies is going to be for $700. All right. And then our credit right here is going to be for cash, right? It's going to be for cash because cash is going out for these supplies and we paid for it in cash of $700, right? So this is where the store supplies comes from right here. And this is where the cash, right? And this makes it all in balance because we're debiting supplies right here. And then we're also crediting cash right here. So supplies are going up in equal amount as cash is going down. 700 up, 700 down, everything's in equal, everything's in balance. All right, so let's go to the other part of this journal entry. The other part of this journal entry has values in our supplies. So the supplies were at a value of $300 right here at the beginning of the period, right? So let's just do a T account just for supplies, right? Supplies. All right, supplies. And it started off with $300 in it. All right? And it ended with $150. And remember, T accounts work in two parts. Things go in and things go out. And it depends on if it's an asset, liability, which side debit or credit is. Supplies is an asset, so the things that go in that make it bigger, well, we had this $700 purchase that was there. So $700 went into it. So we know we had $300 at the beginning plus $700. That means we had a total for the period of $1,000 worth of supplies. And at the end, we had $150. Well, the only way to get there is if we used $850 of supplies. $850 of supplies is what we had to use because it's the 1,000 minus that 150, and that's how we got to the 850 there. And so and remember the 1,000 comes from this 300 and then the 700 from the prior entry. So this is seeing if you know how the entries actually impact each other, because we did this purchase as the first one, and then we want to show the supplies expense. Well, what's the journal entry for that? Well, I'm going to take this first off. The journal entry for the supplies expense is going to be a debit. And it's going to, expenses are always debited right here, right? So we debit our expense, and we're going to call it supplies expense. Supplies expense, and we know the amount. The amount is $850. That's what we calculated here, right? And then we're going to have a credit, all right? And what's our credit going to be? Well, it's not going to be cash. You're going to be tempted sometimes to put cash, but we already paid for these supplies. Remember? We paid for them up here, right? So it's not cash that we're going to credit. We're actually going to credit this supplies account. This supplies account is sitting over here on our asset side of of the balance sheet, and it needs to be reduced. It needs to show that we've consumed the supplies. So we put supplies of $850 here. And that credit of supplies is going to reduce our assets. And so where these map on is the expense So we'll supplies expense, sup expense, not a ton of room here. We'll reduce our net income, which goes into our owner's equity on this side of the balance sheet. On this side of the balance sheet, it's reducing our net income. And we need something else to balance it out. We need either an increase in liabilities, which doesn't make any sense, or a decrease in assets, which makes a lot of sense because supplies are leaving as part of this. And so supplies is credited on here. So we have an expense of supplies expense here, and then we have a credit of the asset of supplies. All right, that is the way you do this entry. So it's a pretty good problem because it sees the point of it is to see if, okay, do you know how to do this basic entry where we buy supplies with cash, and then do you know how it would impact future entries? Do you know how it would impact these other entries in the future? Do you know that even if I didn't give you what the ending inventory was down here, I didn't give you the supplies used, but all you had was the start and ending inventory, can you figure out that you put the 700 in here and then back into this 850? That's the point of this question.